It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. Thank you for joining us today. With me in the KFG studio, certified financial planners Kevin Korhorn and Josh Gregory.
Do you ever wonder what the world would be like if financial advisors were in charge of those messages in your fortune cookie?
Oh, no, I have not thought that, Josh.
They're fortune cookies, right? That is our jurisdiction. we should be the ones writing. That's actually one of my dreams in retirement. I want to be the guy writing those fortune cookies. So today I'm going to give you 3. And you guys, so Kevin and Mike don't know I'm doing this. I'm totally hijacking this show right now.
I'll sign up to be the guy eating them.
There you go. You have to work these 3 fortune cookie messages into the show. You ready for them?
Okay.
Listen carefully. Put your lazy dollars to work.
Ooh.
So someday you don't have to. Beware of the financial advisor living out of his suitcase.
Okay.
$2 in your pocket are better than $1 billion in someone else's pocket.
I think
Today's show, it's all about your questions. We're answering your questions, a variety of topics. So there's your teaser, my friends. We're turning fortune cookies into wise money cookies today on the Wise Money Show.
This is your show.
we can crack those today. If you have any questions for the show, we'd love to hear from you. You can reach out to us 3 different ways online, wisemoneyradio.com. On social media, Facebook, Twitter, YouTube, just search Wise Money Radio. YouTube channel has every episode right there. You can leave comments, you can share, you can like, subscribe, all that sort of stuff. And you can also call and text 574-222-2000. It's 574-222-2000. I hope we will be addressing a texted in question later on in the program today. So, well, Josh, I think I do know where you're going, and we're going to start off the show with a question from Cindy. Here's what she said. Cindy's 68. She's from Mishawaka. I was cleaning out my safe and found an envelope with some old savings bonds in it. Half of them are from the mid-'80s, and I think they've matured. Do they still earn interest after they mature? What should I do with all these things?
Well, Cindy, that is a great question, and I've been helping people with their financial planning and investments for the last 25 years, and we deal with all types of investments, and I found one of the most complicated investments out there is the savings bond.
You wouldn't think it, but that's true.
Yeah.
It's crazy.
Yeah, so it's a very simple concept. You basically lend money to the government, you buy a $50 bond, and it matures and it's worth $100. And so you think, oh, it's not that complicated. Well, actually, it is. And so one of the things that I would tell you, Cindy, is that if you have a bond that's 30 years or older, it's quite possible that it's not earning interest anymore.
Right.
And actually, the Treasury comes out every so often and says, hey, there's so many billion, 7, 8, $12 billion of savings bonds that are in someone's drawer or in the safe or in the safety deposit box that are no longer earning interest. And most people...
$7 billion.
Yeah, most people are unaware that they've got this, I guess you'd call it an investment, that is not earning interest anymore. And so I would encourage you, if you have savings bonds and you're listening to this on a Saturday morning, go get the bonds and look at them and see what the date on them is, and then come up with a plan, make a decision. These bonds, give each bond a name. This is what these bonds are going to do. These bonds are the next car. These bonds are the pay off the mortgage. These bonds are the take the family to Disney. Whatever these bonds are for, give them a name, and then deal with the planning ramifications of cashing those bad boys in.
Because 1 or 2 of those you might want to set aside, depending on how much you have. Set
Yeah,
aside
there may
for
be some
taxes.
tax dollars attached to those. You know, one of the reasons these are so complicated is depending upon when the bond was issued and what type of bond it is, The tax ramifications can be different. The interest accrual can be different. So one of the things I would encourage you to do is, yes, I mean, you've already uncovered the most important part of this whole equation. You found the bonds, right? So now I'd encourage you to go to the U.S. Treasury's website and download a tool that they call the Savings Bond Calculator. It's essentially just a little program that you can put on your desktop there, and you can plug in the actual serial number for each of these bonds, and it will calculate for you how much interest is embedded there, when it stopped paying interest, that kind of thing, when they'll mature. All these details come up when you plug those in. It's almost plugging in the VIN number for your car. There's all kinds of history there.
Yeah.
Yeah, so if you go to treasury.gov, it says right there, EE bonds issued January of 1980 through November of 1988 are no longer earning interest.
Yep.
So I would go and look, and because the issue is the interest that has been earned that has not had any taxes paid is going to have taxes paid. It's unavoidable unless you do it just right and you're using it for education. That's one of the ways to avoid paying taxes on the interest that's earned. I would just assume you're going to pay tax on the interest.
Yeah.
And you say, well, do I really care about that? Here's why you do. Because it could mean if you cash those bonds in today and you're retired and drawing Social Security, more of your Social Security is going to become taxable.
That's right. That's why we love tax planning. We had Ryan Fair on the show recently to talk about some tax planning. We're going to do more of that as well.
The other tax trap that I would look at is if I'm 65 plus and I am on Medicare, I have Medicare Part B, I have to watch my income, because if my income goes above a certain threshold, I will pay more for my Medicare Part B premium.
Yeah.
And so these are the sleepers that people aren't paying attention to, and they say, well, I can do this one thing in this area of my financial life, and it's not connected to the rest of my financial life, and then there are the dreaded surprises.
Yeah, because it is. This gets me onto a tangent that I think, Josh, this is one of your fortune cookies. I think I can't state it exactly. You're too creative for me, but to me, this opens up the discussion about lazy dollars in your financial life. Lazy is sort of a negative term, but basically dollars that are in your financial life that really aren't doing a job. Every dollar should have a job. It's helping you with this, or it's trying to reach this goal, or trying to protect, or trying to grow, or something. And when you have dollars sitting in your financial life that aren't assigned any job, those are lazy dollars. Thinking of $7 billion people don't know about that's not earning interest, those are lazy dollars.
Yeah, when I read Cindy's question, I kind of cringed, because there's been a whole bunch of years that have gone by where those investment dollars have been sitting in that drawer, not earning any interest. So they're not fulfilling whatever purpose they had originally when Cindy or she and her husband, whoever purchased them, they bought them for a reason, to earn some interest, to grow some dollars for the future, but they've stopped doing that job along the way. They're no longer earning that interest. And unfortunately, it happens all the time, where folks do have money that could be doing more work for them.
Yeah.
And I don't necessarily mean earning a higher rate of return. I just mean better alignment with what the purpose of the dollars are, like you were saying.
I completely agree. And a lot of financial planners, financial investment advisors, let's say, might say, well, this would be a good hook to convince you to invest more. And I'm not saying that, especially with how volatile the market's been. That might completely scare you. But going back to what Josh said, if you don't have a financial plan where you can see your entire financial life and know what work needs to be done, as well as list out a whole bunch of goals, basically jobs to do, it's going to be hard for you to allocate dollars towards those jobs. But one of them just could be some miscellaneous credit card debt. It's pretty common for people to have $1,000, couple thousand, $1,500, what seems like a very manageable amount of credit card debt, but that interest is 16% or 18%. It seems small, but as a percentage, it's big. It's big.
Yeah, I met with a couple who are paying very little in taxes, and they have a bunch of savings bonds that they inherited, and they said, oh, we're just going to hold on to these for our kids. And I said, do you think your kids are paying more in taxes than you are?
Right.
And they said, oh, they for sure are. And I said, well, if you don't pay taxes on them, your kids are going to.
That's the planning approach. There's a couple other examples of lazy dollars that we want to point out so that you can make sure they've got the right job to do, as well as should you buy cancer insurance? That's another question that was submitted to the show. We're going to tackle that one as well. That and more coming up here on Wise Money with Korhorn Financial Group.
I think
After that. All right, ready? Do you have any lazy dollars in your financial life? How do you find them? What do you do with them? How do you root them out, get them working for you? We're talking about that right now. This is Wise Money with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard, coming to you from the KFG studios. With me in that studio, Kevin Korhorn, Josh Gregory. Want to say thank you to the attorneys at Ledoux, Kern, and Keene, as well as First State Bank for making the Wise Money Show possible. Thank you very much. If you have any questions, we're actually tackling a question from Cindy right now. If you have any questions, reach out to us. Call or text 574-222-2000. Online, wisemoneyradio.com. You can submit a question right there on the right. And lastly, you can find us all over social media, Facebook, Twitter, and YouTube. Just search Wise Money Radio. You can send questions that way as well. So Cindy wrote in, she's 68 and from Mishawaka, and said she's got some savings bonds that aren't earning interest anymore. And we launched off of that and said, well, a lot of people do actually. You're not alone, Cindy. And so how do you find lazy dollars in your financial life that maybe once you assigned a job to them, but they're no longer really fulfilling that job? So how do you find those? And what are some other examples? And what do you do about it?
I like the example that you gave in the last segment about using cash that's sitting around to maybe wipe out credit card debt. I had a similar situation with a client over in Ohio who had saved up a bunch of money. She really wanted to buy a hybrid vehicle, but and she had all the cash. She was ready to kind of write the check, but she also still had a perfectly fine vehicle that she had inherited from her dad, and it was one of those cars where there's still a lot of miles left in this thing, but less value to it. Those are like the financial advisor's dream car right there. So she was very sensible, and she didn't want to just go sell that car, buy the hybrid just because. So she had all this cash sitting around doing nothing, and she was probably going to be sitting on it for a while. So she actually made the decision to pay off her mortgage early. She had already been, well along her way, and rather than having cash sitting there earning, less than 0.5% at the time, she said, well, why don't I put this money down on the mortgage, save myself 3.5%, and then start building the cash back up even more quickly for the car.
In the context of your financial plan and your priorities, that may make a lot of sense.
And I want to talk to the person right now who's listening to that, who's starting with the premise, oh, well, good for her, I could never do that. I want you to rewrite the story that you're telling yourself in your mind right now and tell yourself, yes, I could do that. I could do that someday. But the only way you're going to be able to do that is you're going to have to do something differently in your life. And that, I'm going to say, start working with a financial planner. When you're looking for a financial planner, make sure you find one that's certified. And there are lots of guys that just sell investments that have the CFP credential after their name. So find one that operates in the 6 areas of CFP, because yes, you can do that. And when I'm at the gym and someone's saying, well, yeah, Notre Dame tickets are now $150 a game. I could never afford those. I'm thinking, well, actually, yes, you could, because you tell me about all the things that you do afford that are important to you.
Yeah.
So people have. This is what I've learned. One of the kind of the truisms is everyone, for the most part, has what they want. And if you start with that and you apply it to my life and you say, hey, no, I don't have what I want. Okay, now it's time to do something about it.
Well, I like that you referenced investment advisors out there, financial advisors who only focus on investments. That's all they sell all day, every day. And there's plenty of folks out there that would say, well, that client I was referring to, they should have taken that money and bought themselves a good growth mutual fund. Start earning their 12,000% a year or whatever the number is, right?
I did not say
The
that.
problem is this is a short-term pile of cash or attached to at least a short or intermediate term need, you don't go attach it then to a long-term investment that can be volatile up and down. Obviously, we've seen in recent markets just how volatile things can get at times, right?
Yeah.
And you don't want the market to be pulling your investment down just at the time that you are ready to go buy that car or use that cash for whatever its purpose was.
So don't take the bait here and listen to Lazy Dollars and think, well, I've got an emergency fund sitting there. I've got to go invest that because these guys are telling me those need to work harder for me. No, if the purpose of that dollar, if those dollars are to give you financial confidence, I heard that recently. Instead of an emergency fund, it's a financial confidence fund. It gives you confidence because you know you've got a backstop. I love that idea. Don't invest those dollars. Now, I would also say it might be lazy to keep them in your checking account. Get those things earning some interest, get them in a money market. But don't take the bait here and think, well, in order to avoid lazy dollars, I need to have them invested. No, you need to have them consistent with the goal, with your financial goals and your financial plan. That's the point.
You know, one of the places in the financial plan that often we see lazy dollars showing up in the form of missed opportunities.
Yep.
You know, how many folks have we ever met who are paying the college bills for a son or daughter, but they're not running the money through a 529 plan first? So that money, you would argue, oh, it's fulfilling its purpose, right? It's cash that we saved up, we pay the college bill, end of story. No, what if you could pay the college bill and save some tax dollars by taking advantage of the Indiana 529 plan?
Yep.
That's creativity that gets missed when you don't have an overall financial plan that you're sniffing out those lazy dollars through.
Let's pivot here. We've got a few more questions to hit, but before we do, sort of current events here in the Michiana area. If you live in the Michiana community and you like the news, then you're probably listening to this channel, this radio station for a reason. But unfortunately, about a year ago, there's a tax preparer, estate planner, kind of turned investment person who recently has been accused of some pretty disappointing things. And because we're a financial show, we thought we'd just address it, clear the air a little bit, because it's a big headline here in this community, unfortunately.
Yeah, when I started in the business back in 1994, this is when we still made house calls, and I'd gone out to a client's house, and I asked, so tell me about the investments that you have now. And she got out a 3x5 card, and on it was written certain investment companies and certain amounts on that 3x5 card. And this was before some of the technologies that we have today, but I was immediately very concerned, because if you're showing me a 3x5 card that states what your investments are, that's a problem.
Right, and not a statement.
I'm
that
just going to
actually
go,
shows-
yep, I'm going to say that's a problem. And I said, so where did you get this? And she said, well, my investment person. And I don't know if any of you remember the name. I do remember the name very well, Mary Lou Sanders. And this was news back in 2001. So
it was national news, right?
It was national news, but it hit home because there were a lot of folks who said, well, all I do is I just take my money down to this person. I trust this person. This person's lived in my community forever. And so, and there, if you go back to December 19th of 2001, the headlines, SIPC, Indiana bankruptcy judge clears way for SIPC to help 30 investors recover up to $2 million. So people say, well, this is a jargon-free zone. What's the SIPC? It's the Securities Investors Protection Corporation. So it's similar to what the banks would have with FDIC. And so the SIPC protects against fraud. So if you're looking at your investment statement and say, man, October was a tough month, I wonder if I can cash in on my SIPC insurance that my guy or gal has. Nope, it's not for that. It's not to protect against the
volatility of the markets going up and down,
Yep.
right?
It is to protect you against fraud. And so if you look, and the reason why is we've had folks that have come in to our office and said, hey, I'm looking at the South Bend Tribune. There's been 5 articles about this person who has had their law license suspended indefinitely. The judge ordered this person to pay $2 million to their clients. So there are some basic protections that we're probably going to have to get to in the next segment that you just want to have to be aware of, because when you think about investments and financial planning and these things, this is a trust business. But I would encourage you to trust but verify, and we'll get into a few ways that you can do that in the next segment.
Plus, we've got Bruce's question coming up about whether he should buy cancer insurance or whether nursing home insurance is just fine enough. But also, about a month or so ago, the Mega Millions became the Mega Billions. Did you have any fantasies? We're going to talk about that and more coming up here on Wise Money with Korhorn Financial Group. All right.
Can we do that? Can we talk about?
Yeah, but I would say quick
bullet points.
Again, I don't know if we really want to dwell on it.
No, we don't need more than half a segment.
But that's the thing. So what's the point? Let's get to that point. Because if the
So what do you want the point to be?
I don't think we want the point to be, hey, there's a whole bunch of charlatans that are out there that you can't really tell. Right? That wouldn't be.
No, the point is there's 99.9 that aren't charlatans, but we haven't had 6 articles in the paper this year. Right? The good guys don't get written up.
Yeah.
The good guys aren't on the front page of the South Bend Tribune. It's
Yeah,
the
but-
bad guys.
Yeah, but who are you talking to when you say that?
Your mother.
Because the listener is saying, I can't tell the difference.
Right, so
So we need to show them how.
Yeah.
Yeah.
I think
I think that's the point.
the principles here are
So
what
let's-
should you never do, and
Right. So let's get to that point.
okay, well, can we just let's bullet point what should you never do, or what should you do, stated in the positive.
I mean, yeah, you should have for all of your accounts, you should have statements from an actual bank or custodian, although I don't want to use jargon, but you should be receiving statements.
Yeah, well, except for everyone that's getting electronic statements.
Yeah.
So you need
Or be able to log
Yeah,
in
but
to a custodian.
you need
and-
to you need to be doing the maintenance that makes sure there's no shenanigans.
And then I agree with what you said earlier that, listen, if you've got elderly folks, or even, if you're married, or even if you're single, bring
So
someone that you trust
is that
with
the
you to
first one?
appointment.
Is that the
Yeah.
first one, or do we say anything about doing broker check, or does that not?
Well, I don't know if that would have prevented anything in this case. The record looked
once
clean.
they're caught, they're caught. But
Yeah. Okay. Third segment. We got to roll. Should you buy cancer insurance? We've got that question from Bruce here in just a moment. This is Wise Money with Korhorn Financial Group. My name is Mike. Joining me, Kevin Korhorn, Josh Gregory, coming to you from the KFG studios. Thanks for listening. Also, thank you, Bethel College Adult and Graduate Studies, as well as Diane Bennett and her team of inspired realtors at REMAX 100. Thanks for making the Wise Money Show possible. If you have any questions, nothing but questions today, reach out to us. You can submit a question online, wisemoneyradio.com. You can call or text us, 574-222-2000. That's 574-222-2000. And all over social media, Facebook, Twitter, YouTube. Just search Wise Money Radio. All right, so quick housekeeping. There's been, over the past year, some accusations about a local I wouldn't even say financial advisor, attorney and tax
CPA.
accountant,
Attorney and
CPA,
CPA.
who was sort of trying to act as a financial advisor and has been accused of some pretty awful, awful things. And the point in bringing this up is that there's certain things that you should be doing to make sure that this is a trusted individual that you're working with. And unfortunately, we were just chatting over the break. I mean, unfortunately, when this sort of stuff happens, it's all over the news and gets a ton of publicity. And so you could be left to think, oh my goodness, who can I trust? But 99.99% of all financial advisors have a good heart. They're trustworthy. They're helpful. And yet the bad apples kind of ruin it for everyone else. And so what are some of the things that you can do to make sure that you're working with someone that you trust?
Yeah, some of the best people in our community that I know are our peers in the financial services industry. So these are good, hard-working people, very trustworthy. One of the things that you should do is you should make sure that you've got statements And so whether a lot of people today have electronic delivery of their statements, so do the work to make sure that you can log in and check your statements, see a balance. You know, the people looking at their October statements aren't terribly excited. You looked at your September statement, you were absolutely over the moon delighted.
That's right.
So this is why you might not want to look at your statements on a monthly basis.
But the point is, you don't want to rely on your investment professional to just create their own statements.
Right.
Because that's where fraud, that's where deceit and lying can come in. You want to get a statement or have online access directly to where the money is held.
Yeah, actually, so we have all kinds of compliance, and we are not allowed to create statements for our clients.
Right.
That's a compliance issue. The other thing that you should be suspicious of is if you're working with a financial professional and they bring up anything in their personal life which suggests they might need some money, and or if they're asking to possibly borrow money from you.
Yeah.
So again, the 6 articles that were in the South Bend Tribune about the one bad apple don't do anything about the truckload of good apples. Those weren't referenced. It was just saying, hey, this is a bad guy needed some bad stuff.
Part of the reason, though, that people get exposed to that is they think they're entrusting money to a professional who is getting them into a legitimate investment. And maybe they even print up on their little word processor some sort of certificate that says, here's what you own, some sort of a certificate of ownership or shares or something. But that's exactly the thing that gets people exposed to fraud, because they're not actually entrusting money to someone where there's watchdogs looking over them.
Sure.
In our industry, we refer to someone who holds your money for you as a custodian. You know, some big names out there are like Fidelity or Charles Schwab. These are huge organizations that their sole job is to hold your money safe for you and help you actually implement the investment ideas that you and your advisor come up with together. But what you may not realize is that there are all kinds of regulators watching over their shoulder, making sure that they are playing by all the rules to help protect your money from fraud. If you're writing checks directly to a financial advisor, other than maybe a fee for them to prepare your taxes or build a financial plan or something, then the risk is that you may be exposed to something you shouldn't be.
Yeah, that's a good one. When you're writing the checks, who are you writing the checks to? So we custody our client assets at Fidelity. So when the client's writing a check, they're writing the check to Fidelity. And another thing that I would encourage you to do is if you have, a lot of times we're working with a couple. And so the couple comes in, they're both hearing what we're saying.
What?
They're both processing. They're both thinking through it. They're leaving. They're saying, what in the world did Mike just say? It doesn't make any sense.
That's right.
And so they're able to process and work on this. If there's someone that's either single or widowed, or if it's a couple that is getting to a point where things are slipping just a little bit, everyone needs a financial advocate. So I would encourage you, if that's your folks or your aunt and uncle, I would at least volunteer to join them when they go and meet with their advisor. And their advisor should welcome you. Their advisor should not feel threatened by you. They should not be worried about anything. Their advisor should welcome you with open arms and say, hey, listen, I want to explain to you the strategies that we're doing. And
To be trustworthy, you need to have character and competence. And so with the financial professionals that you're asking to help serve you, you should have a sense of what their character is. Ask them questions. What are they involved in? Do they volunteer? What do they care about? Are they talking about their family? Are they talking about their kids? Or, to get a sense for what their character is. And then hopefully you're also getting a sense for their competence. But it's really being trustworthy is a blend of those two things. Okay? Hopefully that helps you. Unfortunately, that is going on, and gosh, but hopefully that helps. Bruce is 51 from Napanee. He submitted a question recently. I received a letter about cancer insurance. Should I purchase that, or do I just need nursing home coverage?
Doesn't it seem like everyone that I know who's asked about cancer insurance, there's some sort of background or story there? Maybe some family history, maybe you've had a scare of your own, that kind of thing. And the worry is that, man, what if I'm next? We all know somebody who's been affected by cancer, and you hate seeing what they go through. but then the financial strain that sometimes accompanies that health concern makes people wonder about cancer insurance.
Well, I even just to make this a little bit bigger. So we are always trying to sharpen the saw here and learn new things and get the fresh ideas. And so a big group of the Korhorn Financial Group family, all of our advisors and many of our advisors in training just went to the national conference for the Financial Planning Association, and the Financial Planning Foundation was actually raising money to help families struggling with cancer and the financial ramifications of that, and actually gave I'm a crier, I'll just admit that. I am a crier. I was bawling my eyes out listening to this couple with what they dealt with. And the Financial Planning Foundation is trying to step in and help. However, I do wonder, is cancer insurance the solution to that? Or are other areas of your financial life and your financial plan, do they provide the financial solution?
Exactly.
Not the emotional solution, but the financial solution.
That's right. That's right. To me, there's a checklist of questions that you need to ask yourself before you would make a decision on cancer insurance. Do you have adequate health insurance in place?
That's right.
You know, it's your health insurance that's going to pay these medical bills if you get terribly sick with cancer or something like that. Do you have strong long-term disability insurance? That's often one of the concerns. Like, what if your cancer story, God forbid that you are visited by that terrible disease, but what if it prevents you from working for some period of time and there's an income hit? That's often the case with some families, especially if it's the main breadwinner that gets hit with this. Do you have a big enough emergency fund to cover your medical expenses, your deductibles, that sort of thing, especially if this is going to spread out over more than one calendar year, and you're having to hit a deductible 2, maybe 3 times? And do you have enough margin and flexibility in your budget to be able to adjust and maybe live more financially lean for a period of time?
Oh my goodness, Josh. So the Wise Money Show it's unscripted. We have, a path that we're traveling down with questions and whatnot, but we don't script anything that we say. Josh, those are the exact points that I would say. Now, you've had cancer in your family. I've had cancer. Pretty much everyone knows someone who's dealing with this, most likely in your own household. And there are financial ramifications. So that list, those questions that you just asked, is not a way to say, this isn't a big deal financially. No, it is. But we would encourage you to prepare ahead of time with the right things in place, as opposed to transferring money to an insurance company for cancer-specific insurance.
That's right. If you have the right answers to those questions, cancer insurance is less helpful in your financial life.
We've got more coming up here on Wise Money with Korhorn Financial Group. What are you working on?
It's so good.
Yeah,
so
Josh,
good.
Really, I was going to say those same things, so you said them better.
You know what I was going to say? That the shocking thing is most cancer insurance policies don't cover blank cancer.
Breast cancer?
Nope.
Skin cancer?
Did I tell you I don't like to play games with Josh?
Josh always gets them right. Kevin loves to play the guessing game, except with Josh.
Yes, I do not like it. Yeah, I do
What
not.
number am I thinking of? Between 2 and 4. Josh, you got me again.
It's just Josh is really. If I reflect back on my career, I would say Josh has robbed the joy from me.
For the joy.
Oh, wow.
Trying to. Okay, it is amazing though. Most cancer insurance policy. Do we need to say that, or is that just a YouTube bonus?
That's YouTube
bonus.
Yep.
Okay, I'll
We
grab
didn't talk
another
about
part of
nursing
this.
home
Hey,
side of that question.
And the other thing that we
appreciate
didn't
it.
say is, look, if you have questions, if you feel like you're getting ripped off, or you feel like you have, go find a certified financial planner.
Yeah.
Do we need to say that or not? Is that obvious?
I think we end the show summarizing all that. I think that'd be good.
That's a good summary.
The Wise Money Minute about the lottery. Can we make that one a YouTuber or a Facebooker? And then the same one from that week about the football coaches. Those are two sort of timeless ones, although the $1 million, the jackpot winning was obviously connected to that, but both of those, I thought those messages just crystallized for me. And so
Yeah.
we'll hit that here in a second.
So are we gonna hit the
Yeah.
Megatron? Okay.
Megatron. As a Lions fan, I miss. Wait, wasn't that his nickname? Yeah, back when. Boy, if he hadn't retired early, Lions might have been able to do some damage. Really?
Yeah.
Barry Sanders, too. If they had Barry Sanders.
I don't want Barry Sanders. Dude, I want Billy Sims.
Billy Sims. That's.
Billy Sims was awesome.
All right, fourth segment. Land on the plane. Yes, fourth segment. Okay.
What'd you say?
I said Megatron's too busy dancing with the stars.
That's right. He's a good looking dude, though.
They're actually doing an audition for Dancing with the Stars in the room straight above us. I don't know if you guys noticed that or not.
I wonder if YouTube can hear it.
Yeah.
We kind of filter, well, I mean, because the audio for YouTube doesn't get cleaned up at all. Not that there's much cleaning, but it does get filtered a little bit for the radio, but not for YouTube. I wonder if they can hear it. Anyway, all right, let's roll. What would you do? Where would you go? How much fun would you have if you won $1 billion? We're going to talk about that. Obviously, that happened here in the United States just about a month ago. I'm sure everyone's been fantasizing about it. I have since I was probably 3. We're going to talk about that in just a minute. My name is Mike Bernard. Kevin Korhorn, Josh Gregory with me in the KFG studios. This is Wise Money with Korhorn Financial Group. If you've missed anything, it's been nothing but questions today, your questions. And so you can find every episode right there on the YouTube channel. You can watch every single one of them going on right in the studio. You can submit questions that way as well. You can also find them on podcasts, wherever you listen to your podcast. So it's on Google Play, it's on iTunes, it's on the streamers, all that sort of stuff. You'll want to search Wise Money with Korhorn Financial Group. That's Korhorn with a K. Lastly, every episode's also on the website, wisemoneyradio.com. You can listen to it right there when you're at work or whatever you're doing. Submit a question right there on the right as well. Bruce submitted a question. A couple weeks ago, 51 from Napanee, I received a letter about cancer insurance. Should I purchase it or nursing home coverage? And Josh left off with some great questions that you'd want to ask yourself. And actually, you should be discussing with your certified financial planner. And if you've answered yes to each of those, you've got great health insurance, you've got a good emergency fund, you have good long-term disability insurance, and you've got adequate margin in your life and so on. If you've answered those correctly, then gosh, emotionally, just terrifying when you hear the C word for anyone in your family. Financially, it can be a challenge. But if you've said yes to those things, you probably don't need to give money to an insurance company just for cancer insurance. Well, I don't know. What about nursing home insurance, nursing home coverage? Health insurance doesn't cover that. So these same questions just don't really apply if you are disabled and need to go into a nursing home.
Yeah, to me, so nursing home, if we're going to use a more precise term, we would say long-term care insurance these days. That type of coverage has evolved over time. And it, quite honestly, is, I think, one of the most important types of insurance that you will need eventually. I think, Kevin, you purchased it pretty young in life to make sure that you were insurable and you locked in a price that, is pretty favorable over the years.
And not to disclose anything, but Kevin, you wouldn't qualify for it right now.
Right.
Yeah.
Yeah. I mean, with my level of intelligence and a few other things working against me, I would be disqualified.
Oh, my. Well, it's a major, major risk because, whether you're in your early 50s or mid 50s, now is the time to be educating yourself on this issue. By the time you reach age 65, men have a 44% chance of needing some sort of nursing home care. Women have a 58% chance. It's 70% chance that you will need some form of long-term care or another. That could be nursing home, it could be home health care. Assisted living is another type of care, or even adult daycare. 70% chance. So if we were comparing this type of coverage versus the cancer insurance that Bruce was asking about, to me, making sure you have all those other protections in place that we talked about in the last segment, and then when you get to your mid 50s or so, you need to be coming to a conclusion on this topic of long-term care insurance.
That's right. I mean, your health insurance really doesn't help you with those things. Your emergency fund would need to be extraordinary. I mean, hundreds of thousands of dollars. There's not enough margin in your monthly budget to afford home health care in a nursing home. So that would be a risk that you should transfer, but it's got to be in the context of your overall financial plan. It has to be. So, great question, Bruce. Thank you very much. Oh, last month or so, the Mega Millions became the Mega $1 billion, and someone won it. And just one person won it. That is crazy. South Carolina. And Cindy and I'm just going to confess right now, I've never bought a lottery ticket, ever. And so, and Andy, if you're listening, you bought me a little scratch off for my birthday, and I won $10, and I never even turned that in because I'm just unfamiliar with the whole process.
You didn't know how?
I didn't even know what to do. And so, so what would you do? What would you do? I'm sure you fantasized about it. What would you do if you would have won? While you're thinking about that, Josh, Kevin.
You know, I've actually never bought a lottery ticket either, but there was one time, maybe I shared this story with you before. I went into a gas station at a time when, you know, the Powerball or whatever it was up to 300 million, and the radio station was doing some sort of promotional, and they were just handing out tickets to people as they came in the door. I didn't even know what they put in my hand. I was just, you know, looking for my Gatorade that I wanted, you know. And I got home and I realized what they had given me. And that entire night, all I thought about was, wow, what could you do with $300 million?
Yeah.
And I wasted an entire evening of my life fantasizing about the easy money. But it's fun to do because for a glimmer of time, you have this hopefulness that, wow, what if life could just be better than it is, even better than it is right now?
Right, and so you have to ask the question, when you look at your life right now and you assess your life, what would make your life even better than it is right now? And most people, if they answer the question, it's not more money, it's not a windfall of money. Most people, if they said, what would make my life better right now, it's I have relationship issues with someone in my family. There's someone in my family who's dealing with an illness right now. Fill in the blank. So the idea, it's because you're tempted to think, oh, if I had that money, I'd solve all the problems. Well, guess what? Steve Jobs died.
Yeah.
Paul Allen died. These guys were multi-billionaires with a B, and they had health issues that they couldn't get fixed. Their biggest problem was a health issue that money couldn't take care of. So I look at that, and the other thing that I think about is if you won, and I have a pretty good idea what I'd do if I won. If I won, I would. John Smerella would no longer work for Barnes & Thornburg. He would be my legal counsel and spokesman, and the money would go into a foundation, and I'd spend the rest of my life giving it away.
Spokesman, like he'd be filtering everything that you say, and
Oh, God.
Yes,
I'm
that
going
would
to start
be-
buying your lottery
I
ticket.
know, man,
He'd actually
best
be
investment ever.
he'd be sitting here speaking for me on the radio. So, but it's farcical, and if you think about it, you look at the odds. People talk about what are the odds that I win the lottery? I don't win the lottery. I'll tell you, I got an odd for you. The odds are that 7 out of 10 people who do win the lottery go bankrupt.
Yeah.
Isn't that crazy?
I actually did a Wise Money Minute on this about a month ago. It's on our Facebook page if you want to like that and follow that. It's there as well, and talks about some of those statistics. And actually, so a large percentage file bankruptcy very soon. Actually, a very large percentage end up becoming estranged from those relationships that you would say right now are most important. And a very large percentage end up dealing with some sort of abuse, alcohol abuse, drug abuse, something like that. And so basically, you are most likely better off right now than you'd be if you had won the lottery.
And I wouldn't say I would say addiction. It's
Yeah.
it's the addictions that get the lottery winners. And I have a good friend, Joshua Gregory, and I like to quote him. But he talks about how to manage money you need skill and character. And so if I if I have poor character and little money, it's barely revealed. But if I have poor character and a ton of money, it's totally revealed. So look at the folks in Hollywood, and I can think of examples that you wouldn't even want to share, but look at what they're doing, and you say, well, yeah, they have some character issues, but it's absolutely magnified by all of this money that they have.
Yeah, the problem with sudden money, especially huge sudden money, is you don't instantly have sudden skill. You don't instantly have sudden experience. If you've never managed millions before, what makes you think you're going to be great at managing billions?
Yeah.
Right? So it's far better for you to build your wealth the good old-fashioned way, $1 at a time, one sacrifice at a time. You can do that, especially with a financial plan.
And if you're fortunate enough to fall into sudden money because of a contract or a sale or a lottery winning, I mean, then you can go and invite that character and that experience and that maturity from someone else.
You can hire it.
You can hire it in and not fall victim to some of those other statistics. So thank you very much for listening today. On behalf of Josh Gregory, Kevin Korhorn, myself, and all of us at KFG, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.